Welcome back to session 6, Wedges and Flags. We'll start with the wedges. I think some of you may already have gone through the definition or might have read what's a wedge or a flag. I was trying to squeeze in pennants to it, but didn't have much time to prepare for it. So we'll just try to cover wedges and flags. So what's a wedge? It's nothing but a pattern. Usually it's a converging trend. Take into consideration around 10 to 50 periods. If you're in a day chart, then it's like 10-day or 50-day trading period. So the patterns could be considered as like, rising or falling wedges. And we'll see it in a bit. What's a rising wedge and a falling wedge, depending on the direction of its convergence. And it has a good track record for forecasting the price reversals. And there are three main characteristics that we need to be very mindful when it comes to wedges. The first is the converging trend lines. First is the converging So the three main characteristics, as I was saying, the first is the converging trend lines. Again, we discussed the trend lines. Trend lines is basically just connecting the price of a security based on its trend, whether it's an upward or a downward trend. So the first thing is the converging trend lines. The second main characteristic is the pattern of declining volume as the price progresses through the pattern, whatever the pattern is, the declining volume. That's the key, declining volume. That's the second point that we need to remember. The third is a breakout from one of the trend lines. So use two trend lines. It has to be a converging trend line, declining volume, a breakout from one of the trend lines. So again, it has two patterns. One is a rising wedge, which is a bearish reversal, and a falling wedge, which signals a bullish reversal. And what exactly that means, we'll see it in a bit. So what's the rising wedge? To go back, which signals a bearish reversal, right? So this usually occurs when a security's price has been rising over a period of time. Like usually that's between like 10 to 50 periods, as we just saw. But it can also occur during a downward trend. So basically what happens is it's rising, and then the two converging trend lines. These are converging, right? And the volume is decreasing. First characteristic is converging trend line. Second is declining volume. The third is breakout from the trend line. So three characteristics. Converging trend line converges here. Decrease in volume. You see the volume here as compared to here. You can see it here. It's shown here as well. Declining volume and breakthrough. So breakdown for the rising wedge. Take a quick look. So on TradingView, I have the S&P 500 mini features. So what I did is basically just drew two trend lines, right? Connecting the highs, connecting the lows, right? So the first main characteristic is converging trend line. Needs to converging. It's a rising wedge, so of course it has to be on the upward trend lines. The second thing is decrease in volume, right? And then eventually breaks through this point. Go to the line chart. Breaking through, right? Go to the candlestick chart. So it's kind of like breaking through here. So that's exactly what a rising wedge is. A rising wedge is not a bullish pattern, it's a bearish pattern. So you see that rising wedge, converging trend lines, decreasing volume, and it breaks down. It's a bullish, bearish trend. Similarly, quite opposite to the rising wedge is a falling wedge. So if the price falls over time, a wedge pattern kind of like, occurs um, as the security price kind of makes its final like downward move, and before it converges here down here, the price kind of breaks out above the upper trend line. This is the upper trend line, this is the downward trend line. So this is a downward converging trend lines. Again, it's a declining volume. Three main characteristics. It applies to both the rising as well as the falling wedge. So it converges two trend lines connecting the highs and the lows, declining volume, and then eventually breaks through or breaks out the upper trend line. Let's take a look at an example. On the S&P 500 mini features again, the best example can't be better than what we had in March, this pandemic. If you look at this kind of like, stopped here with this wedge. So if you were to be here around like what, March 2nd. So if you draw two trend lines, it's kind of like zoom in to get a better perspective on it. So you're drawing two trend lines, one joining the lows, one joining the lower highs and lower lows. And then what has happened is these two trend lines are converging here on March 23rd, with decrease in volume. Right. That's a line chart. Okay. Once it converges here, decrease in volume, it breaks through, right? Expand it. The line chart. breaks out above the upper trend line. So the rising wedge is a bearish pattern, and a falling wedge is a bullish pattern. Simple, right? Any questions on that?
So when you're looking at the, let's say, day trading, right? So the same pattern can be followed on a day-to-day basis.
Yeah. I mean, like, see, I didn't even have to really search through this um, S&P 500 to find uh, where a rising edge is and where a falling edge is. I just kind of, if you just like browse through, you can see. I was in a day chart. I mean, like you can do the same thing on a hourly or 4-hour chart. It's basically just going to any point as long as it meets the 3 characteristics. That's what we need to look at. There's no condition that it has to be on a day chart. It can be on any chart. It's just a pattern. Got it?
Yep.
So the period, like, it doesn't matter. As I said, the first thing, but the wedge patterns are usually converging trend lines or 10 to 50 trading periods. Trading periods doesn't mean that it has to be 10 days. It's not limited to days. 10 to 50 periods.